Okay, what is the cost of insurance, and what's the difference between term and permanent life insurance?
Mm-hmm.
Well, when you have term insurance, you're buying just one contract for a term, for a short period of time. So let's just say it's, let's say somebody's 30 years old, this is 121, but you're buying a 10-year term, so out to 40. The cost of insurance. So let's say this axis is the cost of insurance. If you're buying, let's talk about 1 million in coverage. If you're buying $1 million of life insurance for a 30-year-old,
Mm-hmm.
Well, I know I've got $2 million on my son. That costs about $50 a month. So let's just call it 25. So let's say it's $25 a month for a 30-year-old for 1 million. Okay, what's going to happen though is by the time they're 40, that might be, let's call it $35 a month.
Mm-hmm.
Well, if you're buying a 10-year term policy, they take these numbers and you just average them to say, okay, you know what? Let's just take $30 a month. Of course, they're going to throw on a few fees and such, but basically, maybe it'd be $30 a month for a 30-year-old to have a $1 million policy,
Yep.
if they're in good health.
Mm-hmm.
And this is what you need to have, good health, obviously.
Mm-hmm.
Now, permanent policies are just that, they last forever. They're going to pay out when you die, not if you die. So term policies are great. You can buy a lot of insurance for a little bit of money, but after 10 years, it's gone, right?
Mm-hmm.
And they'll jack up the premiums if you want to keep going. So why do you want permanent policies? Well, because you want a policy when you die. And typically for a young person like this, I would pair a term policy for a lot of coverage, probably depending on how much they make. Usually it's about $1 million for every, is it 100,000 make?
Mm-hmm.
No, it's 50,000. About $1 million for every 50,000 you make. So,
Oh yeah.
yeah, that's a rule of thumb anyway. So, what's the cost of $1 million for a 121-year-old? That's probably $999,099, right? So, what you want to do is kind of prepay your permanent insurance. And what happens is, if the cost is this high, you start here, all right, this is your cost. To average that, so here's like the average amount, like we did average this shorter term, you're going to have to pay this much. But again, the cost is this low. So the difference between the real cost and how much you're putting into the policy, let's say that's, I don't know, $500 a month instead of $35 a month. All the extra money, even though it's really only costing the company $25 a month, is going towards crediting, and it's adding value to your account. That's your account value in a permanent policy. And you can get credits based on different things. It could be performance in the stock market with a 0% floor, so you never lose money on your account value, but it's always going to grow. And that's kind of like a quick summary of how they price out long-term and term policies.